Hello everyone, here is Ali Talabi. Welcome back. Today we are going to wrap up the first module. As I promised, we are going to review some hints and also I'm going to show you some questions and provide you the answers. In the first module, and more specifically in the last three lectures, we talk about the operations of the firms. We talk about different form of business, and also we talk about the major goal of corporations. Just a few notes related to those lessons. So if you remember, we talk about the operations of the firm. So we talk about the major famous accounting equations in which assets are equal to liabilities and shareholders' equity. We call the right side financing decision, so where you get your money from, and the left side as your investing decision. So this is where the money comes from. This is where you are spending actually your money on. Now, we talk about the market value of the shares, and we said the market value of the shares is based on the stock price and number of outstanding shares. However, we have to be careful. When we are talking about the market value of the shares is not same as the value of the firm. So how we can calculate value of the firm? The value of the firm is based on the value of the assets. So if you want to be owner of the assets, not only you need to be the owner of the shares, but also you need to be the owner of the liabilities. What does it mean? It means you need to buy liabilities, which means you need to pay off all the liabilities. So if you are able to purchase 100% shares of the company, in addition to paying off all the liabilities, then you will be able to own the assets. In other words, to get the whole firm, you need to have the whole assets, which means you need to have both liabilities and shareholders' equities. So I've seen many of my students, they make this common mistake. When we talk about the total value of the firm, they believe or they think the total value of the firm is same as the total value of the shares, which is not correct. So be careful. That's the first note. We also talk about different forms of assets. We talk about financial assets, and also we talk about the real assets. We mentioned the real assets. In nature, they have their own value, such as land, properties, equipment. Financial assets, they derive their value from real assets. Those are claims on real assets, such as stocks or bonds. However, we also talk about tangible assets and intangible assets. It's more about actually feeling or seeing those type of assets. So when we talk about tangible assets like equipment or land, those are type of assets which you can see. But remember, not all real assets are tangible, not all financial assets are intangible. Here, for example, I have more information. You see, a bond certificate and a dollar bill are financial assets. However, those are tangible assets. So you can feel them, you can touch them. So be careful. There is a fine line between tangible, intangible, and real and financial assets. So just be careful with that. In most of finance investment courses, we are dealing with real and financial assets. Tangible, intangible is mainly discussed in accounting. So maybe we'll come back to that in more details later, but the major focus will be on real and financial assets. So we talk a lot regarding shares and shareholders. Remember, shareholders are not same as stakeholders. We can say shareholders are a major group of stakeholders, but stakeholders include a much broader concept than shareholders. For example, customers, government, competitors, the whole community, those are part of stakeholders. So every shareholder is a stakeholder, but not every stakeholder is a shareholder. Just be careful with that. And finally, I received that question from my student many times. They always assume that investors are just shareholders. So when we talk about investors, it's okay, shareholders or stockholders are investors, which is not true. Investors are those individuals or companies or institutions which actually they are investing their money in your company in different ways. They may purchase your shares or they may lend you money. So both those who are in group of debt or those who are in group of shares, they should be considered as investors. We call them usually debt holders when they give you money, and we call them shareholders. So both debt holders and shareholders are investors, not just shareholders. So be careful with that. So given this, so let's go and look at a few questions here based on the first module and 3 lectures we had. In which of the following organizations the possibility of agency problem is low? So we talk about the agency problem. Specifically, we talk about corporations when you have shareholders, then you have board of directors, and then you have the manager or the CEO of the company. And we mentioned the agency problem. It's a conflict of interest, which might happen between the manager and shareholders. So this is a very common issue in corporations, but you don't see this issue in partnership and sole proprietorship. So the least you might see is the sole proprietorship, just because there is just one person who is handling everything. So the conflict of interest is almost zero. So you are the owner, you are the manager of the company. So if there is the same identity, the same person, there is no conflict of interest. Whatever you decide, you will follow that, and so there won't be any tension in this regard. So the answer will be A, sole proprietorship. In partnership, there might be some conflict. So one partner might decide against the other partner. It's still much, much less than corporation, but for sure, for the sole proprietorship is almost zero. Second question, which of the following is considered as a financing decision? So we talk about financing decision, borrowing money, issuing shares. In general, we talk about raising funds, and we talk about investing decision. A decision to borrow $1 million via bank loan. For sure, that's a financing decision. That's a part of your liability. That's a bank loan. So A should be one of the answers. A decision to purchase the share of another company. Here, you see that's a tricky point. You are not issuing shares. You are buying shares of another company. It's not your own shares. It's another company's shares. That's investing activities. You are investing because you hope you can make more money, or you will receive some dividends, or you will have some capital gains. So it is not about issuing shares. This is investing activities. So B is not correct answer. B is not a financing decision. Be careful. A decision to issue additional shares in a primary market, that's for sure one of the financing decision. Later we'll talk about the primary market and secondary market. The argument here is in the primary market, companies are able to raise funds and they are selling their shares for the very first time to shareholders or investors. Remember, in primary markets, companies, they raise funds, they get money. In secondary market, the already existing shares of the companies are traded. For example, if you look at NYSE, New York Stock Exchange, if you look at TSX, Toronto Stock Exchange, those are examples of secondary markets. So the answers, we'll have 2 answers for this question, A and C. The third question, which of the following is considered as a real and tangible asset? So we talk about the differences. So this time you're looking for real asset, which it means in nature they have value, and also tangible, so you can feel them, you can touch them. A corporate bond, a corporate stock, we talk about them, those are both financial assets. They derive their value from another assets. A patent. Now, you have to be careful. The patent here is actually, as I mentioned here as my note as hint, it's an intangible asset, so it's not tangible asset. And finally, factory. Factory, that's a real asset. By itself, it has value and it is also tangible asset. So the answer obviously will be D. Investopedia provides more information, very nice and I would say easy to read information. So I will post this link in the description so you can take a look and see the differences among real asset, financial asset, tangible, and intangible assets. And the last question I have here is, which of the following is the most appropriate goal for a corporation? We talked a lot regarding this, and we came to the point that maximizing the shareholders' wealth should be the primary goal of any manager. And we define the wealth based on the market value of the shares, which is the stock price times number of shares. So if you look at the options you have here, it seems the best answer will be A, maximizing market value of the shares. So A is the answer. Thank you very much. This is the end of first module. Talk to you soon with the second module. Have a wonderful day. Here is Ali Talabi. Talk to you soon. Take care. Bye.